stock markets in these environments do not prove as a good inflation hedge, especially not in the later stages, like when it all goes vertical. And it goes vertical because there's a complete rejection of cash, complete rejection of money, because at that point, the purchasing power of your money is collapsing so rapidly that people, the vertical climb of the stock market is result of everybody trying to get rid of their cash. Rather than commodity equities, I'm in favor of futures, but there's also commodity ETFs that hold exposure to futures, right?
Hey, Alex, thanks for coming on.
Great to be with you again, Danny.
Hey, so what is your general overview of the market at the moment, your 60,000-foot view?
Oh gosh, my 60,000-foot view is that we are going into a crisis of high inflation, in some places probably hyperinflation, meaning places like Japan, the EU, and Great Britain. And I think it's going to be an epic unraveling. And the reason why I think this has to do with the unpayable burden of debts that are burdening the Western economies, the practically unlimited printing of free money, and also I think the loss of geopolitical influence in Africa, in the Middle East, and in Central Asia. So all of these elements, I think, are in a sort of a confluence, and at some point it's going to probably turn into a perfect storm. And I think that, yes, well, this morning I saw a brief message from ECB Chief Christine Lagarde. I think it was published yesterday, in which she's announcing something, but she's blaming it on climate change, because they can't admit that they're losing in the Middle East, in Africa, in Ukraine, and so forth. And I'll explain why that is extremely relevant. So she's blaming it on the climate change, and she says that we need an overhaul, a huge reform of our financial system, because somehow climate change is making it unsustainable as it is. The reason why it's unsustainable, and this is something that I've been, I first formulated this explicitly in August of 2021, when the United States announced that it would withdraw from Afghanistan. And then I think on the 15th of August, so that's almost three years ago now, the Taliban walked into Kabul unopposed. And in the process, the president of Afghanistan and the governor of the Central Bank of Afghanistan both fled the country with duffel bags full of cash. And so this was very bad as a development for Western influence in the region, Western hegemony, is because the way they exercise hegemony is through these vassal state managed by their, handpicked royals or presidents or dictators or whatever it be. But the empire has to be able to protect them. If they can't protect them, then this is a message to everybody. And then very shortly after that, you had a meeting of 4 heads of state in the Arab world, MBS, I think UAE. A couple of them met informally, but it was obvious that they thought, it was clear that it's very bad news if the empire can no longer protect us, because that means that we have to make nice with our people and we have to make nice with our neighbors. And so then, in the aftermath, you had peace between Saudi Arabia and Iran, initiated by Russia, but then finally brokered by China. And things are changing. Why is this relevant? Because and this is also the same reason why we have these hundreds of military bases all over the place in in commodity exporting countries for the most part, because all these natural resources in African countries, in Middle Eastern countries, in Central Asia, and so forth, these resources represent collateral that's been used as security against loans that Western banks extended to, companies like KBR and BP and Shell and Exxon and so forth, the mining companies, to develop resources in these countries. And then, these resources become they are turned into financial flows in the Western banking systems. But you can do that so long as you control the collateral. And the only way you can control the collateral is by, having political influence in the region. And you shore up that political interest by keeping military bases there. So if, like if the leadership of Niger thinks that they shouldn't be selling uranium ore for $1 a kilo when the market price is between $100 and $200 a kilo, well, then, you use your military to persuade them otherwise. And now if your government there gets overthrown and your military gets kicked out, now people are saying like, hey, we want $100 a kilo, not one. And so now you have to pay up. Now, the things in the market are changing, but it is no longer controlled by the Western corporations and their banks, because these corporations, they do the work of developing the resources and exporting them and putting them on the Western markets. But all of these corporations are clients of these large banks like JP Morgan, HSBC, Goldman Sachs, and so forth. And these banks finance this development, right? And so these corporations' debt is assets on the book of the banks. And these assets are secured by the collateral. Well, if you yank the collateral from underneath this, inverted pyramid, then the whole thing implodes like a house of cards. And so what do you do then? Well, then the only thing you can do is if you can't secure the collateral militarily, all you can do is either let the system implode on itself, which they will not, or you're obliged to go into unlimited money printing. And then you have the same sequence of events as we've seen in countries like Zimbabwe and Venezuela and Argentina and most of the communist countries that fell 30 years ago, Soviet Union, Israel in 1986, and so forth. Weimar Germany in the early 1920s of the last century. And so the sequence of events is not a mystery to guess. Central banks will print. They will spread that money around to their corporations so that they can keep servicing the debt, so that the banking system doesn't implode. But the bill will be paid by all of us through loss of purchasing power, through inflation. And so that's what's coming our way. And so as far as 64,000 feet, is that how high you said?
I said 60,000, but if you want to go an extra
Okay,
4,000,
so from 60,000 foot view, this is what I see. How exactly it'll unfold, I don't know, because these things can unfold very rapidly in the space of 1 or 2 years. That you have a very quick, very rapid collapse, or it might drag out for 10, 15 years. So maybe it's a hyperinflationary unraveling, or maybe it's just an inflation that kind of goes into double digits, 20% or so. And, so I think that United States is probably going into an environment of high inflation. I think that places like Japan, European Union, Great Britain are going into a very likely hyperinflationary unraveling. So that's what's coming.
Where does America fit in all this? I was just looking at a chart recently where showing foreign investments in America continuing to rise up in our stock market. Will America see a similar fate later on down the line?
Yes, I do think so, but I think that the United States, first of all, United States is resource rich, so it always has the option of developing those resources and reindustrializing, and to an extent, this is already happening. So that means creating real wealth and restarting the whole credit impulse and returning to real growth. So that doesn't solve the crisis, but I think it cushions the blow to an extent. It also has the benefit of US dollar still being the dominant currency of foreign trade, and that's not going to change overnight either. And so it has the option of partially exporting its inflation to its trading partners. And then it also has, the United States is primarily funded through, the US economy is primarily funded through the stock market. And stock market is one of the two big absorbents of inflation. So if you're printing a lot of money, most of it ends up in capital markets. So it's not spent on consumer goods. And that means that it kind of absorbs the pressure on consumer prices. So I think that the United States will not be able to avoid high inflation, but it might be able to avoid hyperinflation. And it might be able to uh, drag out the crisis over many years, which gives the government and the central bank a lot more maneuvering space to manage the crisis. Whereas I think that uh, places like Japan, the EU, Great Britain, I don't think they have that maneuvering space, and they might be in for a hard landing and a very, very high rates of inflation, if not hyperinflation.
What about their stock markets? You mentioned Weimar Republic, and you also mentioned this in the last interview, I believe, that in Weimar Republic, you saw nominal all-time highs with their stock market as inflation continued to soar. Do you expect to
Yeah,
see the stock markets of these countries rise in tandem?
uh, yeah, I think that's very likely as well. And I also made that prediction a couple of years ago with respect to Great Britain, but also with respect to the United States, that if this scenario comes to pass, the stock markets will continue to go up, and they might even accelerate to, a vertical climb. Um, that doesn't help investors so much because, like if your stock market doubles, triples, quadruples, but the purchasing power of your money is eroded by 90% or by 99%, the fact that you've preserved nominal value doesn't help you much because you lost all of your real value. So I think that investors are looking at complete total losses in the stock markets.
And then you have to pay capital gains on top of it.
Yes, exactly. And so I think that um, stock markets in these environments do not prove as a good inflation hedge, especially not in the later stages, like when it all goes vertical. And it goes vertical because there's a complete rejection of cash, complete rejection of money, because at that point, the purchasing power of your money is collapsing so rapidly that people, the vertical climb of the stock market is result of everybody trying to get rid of their cash. Stock markets and invested in something real. So this is why we see that, like in 2008 or 2009, stock market of Zimbabwe was the world's best performing stock market, not because the economic situation was so brilliant, but because there was a general rejection of the currency, and people poured money into stocks. And the same thing happened in Venezuela in 2015, 2016, and in Germany in 2021. But this is not a consolation, really. So I think that the only real hedges against inflation are farmland, uh, exposure to commodity prices, gold and silver, but also agricultural commodities and energy, And then, there are other strategies that people should pursue, like downsizing, reducing your cost overhead, getting rid of debt, because you might think that you're paying back debt with worthless dollars, but banks can and do, when they need to, renegotiate loan agreements to their benefit after the fact. Maybe you signed a loan agreement and everything's black and white and clear there, but the bank might come back to you and say, like, well, guess what? This is not working out for us, from now on, it's no longer fixed rate, it's variable rate, and guess what? Your rate just went up, so your monthly payment is no longer $1, but it's $5, or no longer $1,000, but $5,000. So you want to not run that risk.
So what about commodity equities, like mining stocks,
I'm
oil producers, etc.?
Yeah, I don't know. I'm a bit agnostic on that because, like, as go all the stocks, so go the equity commodities. I am I am more in favor of exposure through futures, which, you know, empirically, according to a lot of research that's been done, is the best way to gain exposure to commodity prices. Because obviously, if you hold a future contract, you're not obliged to pay storage. You're not, you just have exposure to price. You don't have to buy the whole thing. You can, you buy it on margin. You don't have to say, if you buy a contract of crude oil, which is 1,000 barrels, that's let's say $80,000 today. You buy that with $5,000 margin, right? You don't have to cash out the whole 80,000. Of course, you need to know how to manage that. And so I think that rather than commodity equities, I'm in favor of futures, but there's also commodity ETFs that hold exposure to futures, right? So you have ETF, if you can't afford $80,000 for one contract of crude oil, you can afford shares of energy ETFs.
I see. What about physical gold and silver?
Oh yeah, absolutely. I think everybody should have at least 2 to 3 months worth of their expenses in physical gold, preferably in coins, not bars.
So with the recent rise in gold prices all the way up, past $2,300, are we a bit overbought at this level? We were at 2,400 just the other week, seemed to come back down, correct a bit. Silver's breaking 10-year highs at just a little south of $32 at the time of this recording. What do you think of the precious metals? Have they run a little bit too far now? Should we expect a pullback? What do you think?
I first of all, I don't think you can predict these things at all. So whatever I tell you is as good as anything you might say. But let's remember that last time we had a high inflation, which was in 1970s, the price of gold went up 24-fold, not 24%, 24-fold. And the price of silver, I think, went up 50-fold. So I think that what we're seeing now is maybe just the start. And I think that the prices of gold and silver have a lot higher to go. Only we can't predict. There might be pullback, there might be brutal pullbacks. The whole commodity complex is extremely sensitive to the liquidity conditions in the market. So when there's plenty of liquidity, they tend to go up. But when the liquidity is yanked out, you can have very, very brutal corrections. And so I think people need to be very careful about how they play this. They should not be leveraged more than, I would say, between 1.5 and 3 times. And also, I've observed in the recent past that a lot of markets, once they started moving higher, they would always accelerate into a nearly vertical climb. We just recently saw that with the prices of cocoa, which for the past 5 or 6 years have been trading between $2,000 and $3,000 a ton. Okay, so they've been really fluctuating around in that band for 5 or 6 years. And then last year they started to trend higher, but they didn't go to new highs. They didn't go to double the new highs. They went to 12,000 something. So, like they went from a base of 2 to 3,000 like this, and then suddenly they started trending up and it accelerated. And so they went 5, 6 times uh, what this previous band was. So we don't know where gold and silver are going. And, in addition to gold and silver, you have palladium and platinum, and you have copper. And so I think that the prices of all of these things are going to go a lot higher than they are now, probably to levels that nobody can predict today. But we can't predict the actual trajectory. And so even, like if you play it too aggressively, even if you get the scenario correct, even if you get the direction right, you could still get killed if you're over leveraged. Maybe you buy at a certain level, then there's a price correction, you get wiped out, and then the price moves back into the same trend, and it turns out you were right, but meanwhile you lost all your money. So that I think that managing your risk is the most important aspect of that. And the whole thing takes strategy and discipline and a lot of patience. But if you can play conservatively, you can be on the winning side. And as I mentioned, you definitely want to hold some of it in the physical form.
That's really interesting because you look back at what happened with nickel 2 years ago. You had this Chinese nickel producer who had short positions on nickel. And you pull up a nickel chart, it went parabolic, just like you said, because of these naked short positions.
Yes. And before that, you had the same thing happen with cobalt, right?
Mm-hmm.
And before that, you had the same thing happen with palladium, which was below $1,000 in 2016, and then it went to close to $3,000 an ounce. And so the reason why I think this keeps happening now, and the same thing happens with in stocks and in Bitcoin. I think that the peculiarity of this moment in time is that, as we said, like the central banks are creating a lot of liquidity. A lot of it ends up in this shadow banking system, which today is over $200 trillion. And the whole of the gold market in the world is about 2 trillion. So that's 1%.
Gold or silver?
1% of the shadow banking system. And so you can imagine that if anybody, and the shadow banking system, this is for the benefit of your viewers, that's, like this is like the banks, the endowments, the hedge funds, the pension funds, all of these, like basically the investor class, which have a lot of liquid investable assets. This is not money that gets printed up by the central bank. This is the money that's already in the system in the liquid form, and that can be moved from stocks to bonds to cash to currencies to whatever. And then like so you have a lot of active investors in this cohort, and if just a small number of them get the wind that maybe gold is the place to be or silver is the place to be, then they mobilize this mountain of assets that all of a sudden starts flowing into some asset, palladium, cobalt, nickel, Bitcoin. And maybe today we're seeing the beginning of this happening with gold and silver. And you see a lot of buzz in the financial press now talking about gold and silver, and like we had a lot of them talking about cocoa and oh yeah, another one was frozen concentrated orange juice.
Mm-hmm.
So you see these vertical charts one after another, and I think that this is why, because there's far too much money out there, and the asset prices are still historically relatively low.
So when you look at these use cases, let's go back to nickel, for example. The nickel miners did not move in tandem with the nickel price. Why
Yeah.
is that?
I don't know. I have no idea. But, there's a disconnect. And I think that maybe part of it has to do is that interest rates are also going up, and the global geopolitical situation is very unstable. I don't know what exactly it is, but besides nickel prices going up, there's a lot of headwinds that might be adverse to equity valuations. Another reason why I definitely prefer exposure to the very commodity prices rather than doing it by investing in companies that, produce these resources. They might have their production in some African country. They might be kicking out. Even if they don't get kicked out, the cost of maintaining operations in these countries is definitely going up.
Yeah,
Not
it's a
just because
secret.
interest rates are going up, but you have the leadership of these commodity exporting countries is becoming more and more assertive because they're seeing the weakness of the Western powers. And so, where once upon a time you were selling your uranium more at $1 a kilo and you kept your mouth shut, now people are saying like, well, it's worth 100 at least. So you're gonna have to pay me more. We can continue doing business together, but it's going to be more. And then, the fact that Western powers can no longer protect their, kings and dictators or whatever have you there, it means that they're going to have to make nice with their people domestically, which means that when the local workforce demands higher pay, well, instead of bringing out your police and beating them up, you might have to actually pay them a living wage. And that means that these corporations that are developing the resources are going to have to pay up. So even if they're not forced out, Western corporations are maintaining operations in a lot of these countries that have had it with Western colonialism. The cost of staying there is 100% going up, and it's going up a lot. So, in the end, I guess you're going to see that in the stock price that no longer moves in tandem with the price of the underlying commodity.
And this is a tailwind to inflation. So it's kind of like a feedback loop where inflation caused this to begin with, this tightening of all these different countries,
Yes.
which then causes more
Yes.
inflation.
Yes, exactly.
So that
Exactly.
so
And
that's where you get your exponential rise up in these.
yeah, exactly. And then this all ties in with the commodity super cycle hypothesis because, a lot of market observers kind of expect that over the next 10 to 25 years, we're going to see this massive cyclical rise in commodity prices, especially with respect to equity prices with other financial assets. And so I think this is all part of this perfect storm that's gathering and that's going to pummel the Western financial markets hard. Uh, I see that the currencies are going to be losing purchasing power. I see that the interest rates are going to be going up, meaning that the bonds are going to continue going down over the longer term. And equity markets are probably going to continue going up, but they're going to be outpaced by the loss by currency loss, but the loss of currency purchasing power.
I want to go back to your point about the allocation of wealth in the shadow banking system or or institutions, as some people would want to call it, in terms of gold and silver, gold and precious metals. You look at family offices in aggregate. I was just looking at this chart not too long ago. 1% of their total allocation in aggregate as of 2024 is in gold and precious metals. 1% is in commodities. 1% of global assets, gold and gold miners make up 1% of global assets.
Yeah.
So you juxtapose that with the 1980s, 1981, it was 26%. In the
There you go.
1970s, it was 30%.
Yeah, there you
So
go. And so if this relationship changes even marginally, even if it goes from 1% to 2%, I can put tremendous pressure on gold and silver prices, which means that the appreciation that we have seen over the past few months could be completely eclipsed over the next year or two or three.
and that's not even factoring in any war that could,
And that's not even factoring any war. Exactly.
which
Exactly.
which which is inflationary. Every war is inflationary.
Yep, correct. And we got a lot of war these days.
Yeah, yeah,
It's
especially
just
nowadays.
it's like one of the biggest export industries from the West.
Yeah. So you mentioned rates staying higher or going higher. Can you kind of expand on that? How can we keep seeing inflation with rates going higher? Is that precedented or not?
Well, if you're lending money and you're lending it at 5% and inflation is 5%, then you didn't make any return on those loans. So if inflation is 5%, I'm gonna say like, well, okay, in that case, I guess my interest rate is going to have to be 7 or 10% or something like that, so that I actually generate some return on the money I lend out. So, even expectation of inflation already puts upward pressure on interest rates.
Gotcha. So, I mean, to kind of wrap things up, what are some closing comments you want to leave with the audience?
Well, I think that as we discussed, going into the going into this crisis that we're definitely going into, uh, and which might be very severe and short-lived, or it might be drag out for over 10 or 15 years. You want to downsize your life as much as you can to keep your expenses low. I think you want to be rid of debt as much as possible. I think you want to own some gold and silver in small denominations. I think you should consider gaining exposure to commodity prices in a broader way. So, not just gold and silver, but generally metals, industrial and precious, energy, prices of energy are going to go up higher, and agricultural commodities as well. Um,
And just so you
most
know,
of
you're not the only one saying this. Jamie Dimon said something similar just a few days ago about
Oh, I think
stagflation.
it's
Yeah.
I think it should be common sense. I think
Yeah.
it's not even anything particularly clever. But I think that the thing that is the most important for anybody to do, and it's nothing to do with finance or investing, it's in cultivating relationships with your local community, with people living around you. Get to know them. Get to know what they know how to do and what they're competent in. See how they can help you and see how you can help them. Because the day maybe you go to Walmart and you don't find stuff. It's good to know which of your neighbors knows how to do what. There's going to be somebody who's good at fixing cars. There's going to be somebody who can raise some fruits and vegetables and exchange them. Somebody who might have chickens and who can swap eggs with you. Uh, you know, the crisis that's coming our way is going to be the dollar crisis. And the reason that it affects us is because we are obliged to use dollar as a means of exchange. So, if the dollar becomes unavailable or scarce, or its purchasing power starts to collapse, it's not that the earth no longer produces crops and the chickens don't lay eggs and that, baker isn't capable of baking bread. Is that everybody's doing that in exchange for dollars and if there's no dollars, their business collapses. And, even though the economy can function perfectly well, it grinds to a halt because the means of exchange becomes unavailable. But, you know, in the local community, people can exchange favors as people have done for millennia. You know, like, I help you out, you help me out. And we don't even have to exchange any money. You know, people understand that there's a lot of mutual support in a local community. But you have to know who's there. You know, like, you have to know people. You have to establish a relationship of friendship and trust with them. And I think that is far and away the biggest factor of resilience through the coming crisis. And, you know, if you have I have to also say, you know, I hear often people talking about a community of like-minded people. That's very nice, but you don't need like-minded people, because, you know, like, if you're in a community of former stockbrokers, you know, you're not really resilient. You need a community of people with a diverse set of skills. So you need somebody who knows how to fix teeth. You need somebody who knows how to fix cars. You need somebody who knows how to butcher animals and raise crops and raise animals, uh, fix appliances, roofs. You know, basically, you need a roof over your head, and you need food, and you need clothes. Everything else is optional, a luxury. But those few elements are relatively simple to keep flowing. But you need to not depend on the corporate structures like Walmart, like you know, all these supermarket chains, the banks, the large corporations. You need to learn how to depend on your neighbors. And so I think, in addition to all the investment advice, that, I think, should be the most important part. And I also, you know, the authorities confirm this themselves, because if you try to organize a local get together, the odds are that they're going to try to prevent you from doing that. They don't want you to do that. And I've been invited on several of these kind of local people getting together networking events, and the extent to which the local authorities went to prevent the event from taking place is absolutely staggering. I'm talking about law-abiding, ordinary people getting together to do nothing but to hang out, talk, mingle, get to know each other, tell each other their stories and what they do and how they do it, and that's it. Well, you know, you can't do that today.
And it's
So
happening everywhere. It's happening everywhere across the globe. So it's like,
yeah,
where do you go?
yeah, exactly, exactly. But anyway, you know, we are free people. This earth is our birthright. We don't have to ask permission. We don't have to ask permission. I don't need anybody's permission to go hang out with my neighbor and asking questions and telling him stuff. And same goes for 3 neighbors and 10 neighbors and 1,000 neighbors. Whose right is it to prevent me from organizing a get together of neighbors? Nobody's. That's obviously a clash between the authorities and the free people. And I think that ultimately the free people will prevail, but they're going to have to claim their freedom. They're not, you know, if you're asking for the authorities to allow you to do something, you've already implicitly declared that you don't have that right, but for the indulgence of the government. Well, that's, you know, putting the cart before the horse. And
Which
then, you know, also, I would like to point out that, because many people think that stocks or real estate are good hedges against inflation, they're not. They really are not. So, you know, if you think that you're going to weather the crisis by having, you know, residential investments where people pay you rent, you're not. And stock market also is not going to protect your wealth against inflation.
Fantastic. Alex, thank you so much for coming on. Where can people find you?
Well, I'm easy to find on X, formerly known as Twitter. My handle is @NakedHedgy. And I also have a Substack. It's Alex Krainer's Trend Compass. And then from there, I have a website for traders and investors, which is called iSystem Trend Following. And that's basically that.
Okay. Well, if you enjoyed this video, be sure to give it a like, comment down below. Let me know if you agree or disagree with any of Alex's takes. Subscribe to the channel if you haven't already. You guys need to subscribe. 85% of all viewers of this channel are not subscribed. So do me a great service if you subscribe. Buy me a coffee, support the channel whichever way you can, whether it be monetarily or if money's tight at the moment. A simple like, comment, and subscribe also goes a long way. Every bit helps. With that said, you guys, I hope you enjoyed the video. Thank you so much for your time, and I will see you in the next episode. Bye, y'all.